Where is your money? No, really. Is it in your pocket, wallet, or is it nowhere? Most of the world's money doesn't actually exist as physical paper. It's just bits of information flickering in the super safe hotels we call banks. Savings account. It is one of the oldest and simplest ways people store money. Your money is resting safely in a bank, but it isn't completely stagnant. While it sits there, the bank quietly pays you tiny amounts of extra money, called interest. Not a lot, though. Your money is basically doing one push-up every month. But here's the kicker. While your money rests, the bank is wide awake. They're lending your money to other people to build houses, buy cars, or start businesses. And they pay you that sweet, tiny interest. In a way, you are quietly part of that system without doing anything at all. It is safe, stable, and predictable, but it is also slow. What if you didn't want your money to just do push-ups? What if you wanted it to climb?
Stocks. When you buy a stock, you aren't just buying a ticker symbol. You are buying a small ownership share in a company. If you buy stock in a pizza company, you own a microscopic slice of every pepperoni, every oven, and every delivery bike. You are financially connected to their success. Money. If the world decides they love that pizza, your tiny slice becomes a feast. This is why people get excited when companies invent popular products, games, or apps. But if they go out of business, well, your slice disappears into the void. What if you want the company, or even the government, to owe you? Bonds. Kind of the opposite of stocks. Instead of owning part of something, you are lending money to it. Governments and companies borrow huge amounts of money from investors and promise to pay it back later with interest. Many large countries use bonds to fund roads, schools, and public projects, while companies use them to expand operations. Compared to stocks, bonds are usually considered slower, steadier, and safer, like a tortoise racing a Ferrari. The Ferrari might crash, but the tortoise usually makes it to the finish line. Now, choosing one stock is hard. It's like trying to find one specific ant in a colony. That's why we have mutual funds and ETFs. Instead of buying one ant, you buy the whole colony.
Mutual funds. So instead of betting everything on one company, people spread their money across many different ones at the same time. Imagine a giant basket. Now imagine a guy named Dave. Dave is a professional basket loader. In a mutual fund, you and thousands of other people give your money to Dave. Dave takes that giant pile of cash and goes shopping. He buys a little bit of tech, a little bit of energy, maybe some pizza stocks. He does the math so you don't have to. You own a share of the whole basket. But Dave doesn't work for free. And because he's constantly swapping items in and out of the basket to find the best ones, it can get a bit pricey. It's like paying for a personal shopper when you just wanted some groceries. ETFs, or exchange-traded funds, are similar to mutual funds but trade on the stock market like regular shares. They are still baskets of many companies, but here's the twist. They live on the stock market. You can buy or sell a basket as easily as you can buy a single share of a company, all day long. Why do people love them? Because they usually have lower fees. Dave isn't constantly picking through the fruit to find the ripest apple. The ETF often just follows a theme, like video game companies or green energy. It's a flexible, low-cost way to get diversification. Or, as humans like to say, not putting all your eggs in one basket, because, well, baskets can break. But what if you don't want Dave at all? Index funds. It doesn't try to pick the winners. It just buys everyone. It's the participation trophy of investing. Except in this case, the trophy actually gains value over decades because historically, the whole market tends to move up. Instead of trying to find the winning companies, an index fund buys everyone. If the index is the top 500 companies, the fund just buys all 500 and sits there. But here's the weird part. Historically, most clever investors actually lose to the participation trophy over a long time. Because while individual companies might fail, the entire market, the collective effort of millions of humans working and inventing, tends to move in one direction, up. But some people want something they can touch. Real estate. Land. We live in a world of 3 dimensions, and in those dimensions, you need a place to exist. Land is the ultimate limited edition item. Nobody is making more of it. When you invest in real estate, you're buying a coordinate on the map. You can make money in 2 ways. 1, you let other people live or work on your coordinate, and they pay you rent, essentially a subscription fee for physical space. 2, you hold on to that coordinate until the world around it changes. Malls, buildings around it, making your specific patch of dirt more famous and valuable. Real estate has been used for wealth building for centuries because land and housing are always connected to daily life. However, property investing usually requires larger amounts of money compared to other investments.
Gold. For 5,000 years, humans have had a collective obsession with a specific yellow metal. Gold doesn't do anything. It just sits there. But it's rare, it doesn't rust, and most importantly, everyone agrees it's worth something. Investors often buy gold during uncertain economic times because it is seen as a stable asset. Unlike stocks or businesses, gold does not produce income on its own, but many people trust it because of its long history. Cryptocurrency. It is a digital form of money built using blockchain technology. Unlike traditional currencies controlled by governments, cryptocurrencies are usually decentralized. Bitcoin became the most famous example after appearing in 2009, followed by thousands of other digital coins. Some people see crypto as the future of finance, while others view it as highly risky because prices can change very quickly. Dividend stocks. When you buy a normal stock, you're betting that the company will get more famous and valuable, so you can sell your share for more later. It's like buying a rare Pokemon card and hoping people want it more next year. But dividend stocks are different. They are big, stable companies. Think of the people who make your soda, your shoes, or your electricity. They've already won the game. They have so much extra profit that they don't know what to do with it. So they just give it to you. Every few months, just for owning a tiny piece of them, they send you a thank you check called a dividend. You don't have to sell your share to get the money. You just hold it. It's like having a tree that doesn't just grow taller, but also drops a few apples in your lap every season. So, where is your money? Comment down below. Thanks for watching. Subscribe.